Hi everyone. The purpose of the video today is to talk through the LIFO method of valuing inventory. And LIFO stands for last in, first out. I have already produced a video on FIFO. However, in this video, I will compare, once I go through the LIFO methodology, I will actually compare this to the FIFO method so that you can get it solidified in your mind what is different between the two approaches. So first of all, from a LIFO methodology, last in, first out is exactly that. So let's just walk through this example. We have a beginning inventory of 0. We have some purchases that we have made. At the end of the month, we have a total goods available for sale of 1,900. That is adding up all of these units, comes up to the 1,900. Also, over here, the value of each purchase, meaning the units times the price, we have a value for each one of those purchases. All of those added together equal the goods available for sale value. So at the end of the month, we have 1,900 units at a value of $266,000. The ending inventory in a LIFO method, so when we have a person go out and actually count the inventory, they come back and they say we only have 500 units of this inventory on hand. So when they do that, we will value that under the LIFO methodology using the first cost that went into the inventory. So our first cost is $125 because the first cost that occurred for us as far as purchasing inventory was on July the 2nd. So our ending inventory is valued at the first cost. And you see my little note right over here that states that specifically. So the 500 times $125 is $62,500. That's the value of our ending inventory under LIFO. Our total goods available for sale minus our ending inventory units gives us the total goods sold. So we sold 1,400 units out of this 1,900 units. And our value is, this value minus the ending inventory is $203,500. So let's vet this out. Of the 1,400 units, since we're using a LIFO methodology, the last ones in are the ones that are sold. Okay, so our last inventory coming in was on July 24th. So that 800, we sold all of those at $145 a piece. We sold all of the ones on July the 10th for $150 a piece. And we also sold, out of the July 2nd, we sold 100 units. Because cost of goods sold, price valuations start with the last prices. Last in are the ones that are being sold. So the last one, $145 a piece, then $150 a piece, and then $125. All of that, when you multiply it all out and add them up, is $203,500. This number matches that number. Okay. So the important pieces to remember here is that for LIFO, the ending inventory uses the first cost as its valuation. The cost of goods sold valuations are using the last prices. Very important. And it's exactly the opposite for FIFO. So let me go back over here to FIFO using the same numbers we have here. Going back over to FIFO, the ending inventory is using the last cost going into the inventory, as opposed to LIFO using the first. Okay? So it's important to see those distinctions. Here, the cost of goods sold is using the first prices, so it's starting with $125, then $150, then $145. So it's starting with the first prices. LIFO is using last prices. Okay, so the important thing to know here is that what I've done here on the LIFO page of this little workbook is I've put in, the versus FIFO methodology. So here's the LIFO, and here's what was calculated for FIFO. The other portion that I want to make sure that you understand is that from a ending inventory perspective, this note right here is in regards to ending inventory. Okay, so in a period of rising prices, our ending inventory FIFO valuation is going to be higher and LIFO is going to be lower. So as you can see here, FIFO is higher, LIFO is lower from an ending inventory standpoint. Now, in a period of rising prices, when we look at cost of goods sold, this note here has to do with cost of goods sold. So in a period of rising prices, FIFO is going to be lower, as you can see here, and LIFO is higher. Okay, you may have sometimes questions that will ask you things about what is the ending inventory valuation. They may ask you what is the cost of goods sold valuation under these different methodologies. They could ask you in a period of rising prices what happens to inventory valuation, and in a period of rising prices what happens to cost of goods sold, which is higher, which is lower. So just be aware of the different things that they can ask, and you're more than welcome to watch this video as many times as you need to get this solidified in your head. And please, if you have questions about it, please leave them below, and I'll be happy to get back to you. And I look forward to talking with you on another video. Thank you.